Then Tuesday was day two of the potential banking apocalypse. MBS were down 33 basis points on the open. CPI came in at up 0.4% month over month. Year over year, it declined from 6.4% to 6%, mostly based off of the comparison number last year. In line with expectations, month over month core CPI came in at 0.5 versus 0.4 estimate. Year over year, core CPI came in at 5.5 versus a 5.5 forecast. This was 5.6 previously. Goods prices stayed the same. Inflation was mostly from services and shelter, shelter being 60% of the total increase. Shelter is up 0.8% month over month and 8.1% year over year. What a difference a little systematic banking crisis makes. Without the last 3 business days, today's CPI data might have tipped the scale towards a 50 basis point rate hike next week. As it stands, Fed funds rates futures are barely budged in response to all this. The regional banks are all rallying today, despite news that Moody's has placed a slew of them in review for downgrade. Western Alliance was up big this morning as that increased liquidity. First Republic is up 50%, as is PacWest. If it weren't for SVB, CPI numbers would justify the 50 basis point hike next month. But with cracks showing in the financial sector, that probably can't do that. The Fed fund futures are predicting another 25 basis points with small probability the Fed stands pat, although that does absolutely nothing to help with inflation because light better than forecast, it's still moving in the wrong direction, which is making life expensive for a whole lot of Americans. Small business optimism improved in February but remains well below its historical average. Inflation remains the biggest problem on that. Labor is still a problem, as many small businesses have unfilled positions and cannot find workers. Now, I'm going to say that they can't find workers that want to work for what they want to pay and how they treat their workers. It seems like a lot of people that treat their employees very well can still find people. With the second biggest bank failure in history on Friday and the third biggest over the weekend, it isn't entirely insane to keep an eye out for imitators. This was the concern as recently as the wee hours of the night when Fed fund futures moved to roughly 4% implied yield for the meetings coming up after this week's action. As hours ticked by without another failure, the number moved up about a half a point. This has been the dominant theme today, with CPI not having much of an impact. MBS fared far better than the Treasuries, mostly because Treasuries fared so much better than MBS until the reversal. At the end of the day, we ended up on the MBS was down 30 basis points at 100.19, but the Treasury was up 14 basis points, which is a pretty heavy move on the Treasury. So ending up at 100.19 on the MBS, that puts us right in this very narrow range. So we have the ceiling at the 100-day moving average, which is the purple line, and then that red, really wacky curved line is our 25-day moving average. While the failures of Silvergate and Signature are purely crypto-related and meaningless, more or less in the grand scheme of things, there are 2 lessons to be learned from the failure as SVB. First, major risks to the financial system can come from non-money center banks, and second, borrowing short by holding customer deposits and lend long by purchasing long bonds and MBS to slightly juice returns is a terrible idea. The Fed now raises only 25 basis points, and that's from the Bowtie economist. That was his thought on that. We also got news that Guild, the growth-oriented mortgage lending company originating and servicing loans since 1960, has acquired Cherry Creek Mortgage, a privately held Colorado-based lender with physical branches across the country whose business and customer-centric approach closely aligns with Guild.